Right now on Monday, August 17, 2026, Euro to US dollar has cleared 1.1600 and is holding above two technical zones that professional traders watch closely: the 100-day simple moving average and the 50% Fibonacci retracement of the recent decline. That combination matters because a single breakout can be a fluke, but holding above both levels suggests buyers are absorbing every dip. The pair turned higher on the back of a broad sell-off in the US dollar, not because the euro suddenly became a high-yield favorite. In simple terms, this looks like a dollar problem rather than a euro triumph, and that distinction will decide whether this move has legs. The clearest evidence that this is a dollar story comes from other major pairs. The British pound has hit a 3-month high near 1.3570 against the dollar, while the Japanese yen is stuck in a downside band between 158.00 and 160.20 according to UOB. Even the Australian dollar is gaining against the yen despite weak Chinese data. When three very different currencies press higher against the dollar at the same time, the market is selling dollars rather than chasing one currency. For euro to US dollar, the 5-day moving average now sits near 1.1592, just below 1.1600, which means the short-term trend is still considered buy-side. The 100 SMA and the 50% fib have become support, and the next big target is the 200-day moving average. For traders, holding above 1.1600 changes the risk maths. Long positions now have a logical invalidation zone if the pair closes back below the 100 SMA or the 50% fib, because those were the levels that defined the original breakout. For businesses and travelers, a stronger euro means European exporters are less price competitive in dollar terms, while US imports become cheaper for Eurozone buyers. The move also feeds into inflation expectations. A stronger euro can dampen imported inflation in the euro area, but a weaker dollar can push commodity prices higher globally. This is why the breakout is not just a chart pattern, it is a signal about where global capital is moving right now. The near-term outlook depends on whether dollar selling continues and whether euro to US dollar can turn 1.1600 from resistance into support. If it does, the 200-day moving average becomes the next upside magnet. A healthy pullback toward the 100 SMA or the 50% fib would not be unusual, and it could strengthen the bullish case if buyers defend those levels. The risk is a headline that halts dollar weakness, because a closing candle back below 1.1600 would quickly turn this breakout into a false one. Watch the British pound and Japanese yen for confirmation. If the pound keeps pushing higher and the yen stays weak, the dollar selling bias is likely intact. So the lesson today is simple: euro to US dollar is above 1.1600 and bulls are in control above the 100-day simple moving average and the 50% Fibonacci retracement. But the real driver is broad US dollar weakness, not a sudden euro strength story. If you trade this, treat the 100 SMA and 50% fib as the line in the sand, and do not assume the move is safe just because momentum is positive. The 200-day moving average may be the next test, but only if the dollar keeps falling. That is the trade, the risk, and the opportunity in one clean picture.